Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Well, hi there. Welcome to Better System Trader. This is episode number 145. And I think it's pretty safe to say we've had some pretty interesting times in the markets so far this year. There has been an increase in uncertainty. We've seen higher volatility and a lot of developments outside of the markets that seem to be having an impact on the markets. Now, some traders may be seeing the current market environment as riskier than it has been in the recent past. And other traders may be enjoying the increased opportunities. But whichever way you look at it, there is something that all traders need to consider if we want to last a long time in this business, and that is how to protect capital through proper risk management. The guest on the show this episode is risk management expert Aaron Brown, who has worked for JP Morgan, Morgan Stanley, and even spent 10 years as risk manager for Quantbased hedge fund AQR. In our chat today, we're going to cover some interesting and practical aspects of risk and risk management and how we can plan for and protect ourselves, which you may find incredibly timely given recent market developments. Some of the things that you'll discover in my chat with Aaron today are the biggest misconceptions that traders have about risk and how we really should be looking at risk instead. Aaron also explains why low volatility environments can actually be riskier than high volatility environments. And he'll also share one of the biggest risks to the market that can impact everyone and can be hard to measure and how we can plan for it. Aaron will also share with us how traders should approach drawdown management, why correlations are mythical and the right way to think about financial markets instead. Plus, we'll be talking about the risks in the market today and what he thinks of the current market environment. So lots of great stuff in there. Let's jump over now to my chat with Aaron Brown. Hi, Aaron. Welcome to the show. It's really great to have you here.
Hello, Andrew. Thanks for having me.
I'm really excited to be talking to you today, and considering what's happening in the markets recently, this could be a very timely discussion, I think. But before we get into all of that, let's get to know you a little bit better. So I know that you've had a long and interesting career in the markets so far. So let's get started with, I guess, a little bit of your background, how you got started in the markets and what actually sparked your interest in the markets.
Well, I won't take too long on this, but I am going to go back to fairly early childhood. I was of a generation that was inspired by Ed Thorpe's book, Beat the Market, and also, Beat the Dealer first, and later Beat the Market. And similar books and works. So this is in the 1960s, early 70s. And so I'm, under 10, becoming a teenager. It's fascinated by the idea of beating things, of using mathematics. So you could beat the House, you could beat the market, you could beat City Hall. You could do all of those things everybody said you couldn't do. So I spent a lot of time in poker and professional poker and blackjack and sports betting. But like a lot of people, I pretty quickly figured out that there was a lot more money in finance and it was a lot easier. So I moved in, so this is early 80s now, and I'm trading options on my own. I'm doing what we would now call quantitative in investing, using techniques I invented myself or kind of with small groups of people who were like-minded. And a bunch of us came to Wall Street late 70s, early 80s, and, we took over. Just so much better than everybody else, not because we're so smart, just because they didn't know any math, or if they knew math, they weren't using it. Brings us up to 1987. The crash of 1987 was a much more transformative event. People remember, for your younger listeners who weren't born then, this is October 19th, 1987. S&P 500 falls almost 25% in a day, something that nobody thought could happen, but also there's a complete reorganization, restructuring of financial markets. Everything changes. And I and a few other people of my generation and way of thinking realized that risk management was going to be a lot more important than just making money. Making money was actually pretty easy, but you lost it all. The crash of 87 seemed almost, you have to be almost paranoid. It seemed to like seek out and destroy every quant strategy, including those that would have made money if you'd been able to hold on to your positions. The only quant of that era who made a lot of money was Nassim Taleb, and he was a big participant in a lot of these meetings, and his theories about risk were just way ahead of everybody else's. I don't actually completely agree with them, but at least he was thinking the right way about it. So for the next 5 years, I really spent my time trying to figure out how do you manage the risk of these strategies. I'm primarily thinking about quantitative strategies, but I also got drawn in at JP Morgan and later at some other institutions to managing risks for non-quantitative strategies as well. So I go through, work for Morgan Stanley, moved to AQR Capital Management, the quantitative hedge funds in 2007. I was their first risk manager, and I did that for 10 years. And last June, I decided to get rid of my commute. I don't call it retirement. I call it simplifying my life. I'm teaching some courses. I'm doing some writing. I write a column for Bloomberg. I do interviews, but I don't have to get on a train every day. And if I feel like, going to the park and spending the day watching the birds or eating my lunch, that's all I can do it.
That sounds nice. Sounds very nice.
Like it.
So I'm actually going to ask you a little bit about the 87 crash a little bit later. But before we get into all of that, perhaps we can start with a little bit of the risk management basics or risk basics. Can you explain what actually is risk? Like, how do you personally define it?
Okay, well, I guess the biggest misconception people have is that the purpose of risk management is to predict or prevent disaster. We can't do that. People who predicted disaster are the enemies of risk management. They're trying to guess what's going to happen and building defenses against it. So risk management is think about anything that could plausibly happen, even some pretty extreme plausible scenarios. And you don't try to prevent disaster. The way you prevent disaster is not take any risk, and then you never make any money. The way to think about it is you want to make sure everybody understands the risks and you're taking them seriously. The way I define the perfect risk manager is after the disaster has occurred, and the risk manager is not going to prevent all your disasters. You walk into the room and you say, well, we all knew the risks, and everybody nods their heads and said, yeah, we knew the risks. If you do that, you've done your job as a risk manager. Your job is not to decide which risks to take. It's to make sure everybody understands those risks and their consequences.
Mm-hmm. Yeah. Okay, so I think that's a very important distinction that you make there, that it's not about predicting or trying to avoid the risk, but rather for recognizing and understanding some of the possibilities. So I think we might dig into that a little bit further in a minute. But I just want to ask you, why is risk management so important? I think it's kind of a really obvious question, I guess, but there have been a lot of risk management lessons in history, especially on the what not to do side. Is there any one particular instance that really stands out to you that contains a good lesson for traders on risk management?
It's a little hard because what people call risk management failures and lessons are usually people who took a lot of risk. And that wasn't necessarily a stupid thing to do, given their beliefs, given their certainties, given their positions. I might say, for example, Amaranth Capital Management, one of the hedge funds that blew up in 2006, something like that. They had gigantic natural gas positions. They had good fundamental reasons for believing those were solid positions. We say they blew up. What they did is they lost about 60% of their value of their assets, and they shut down and they returned money to the investors. But, they were supposed to be a high-risk hedge fund. They were supposed to swing for the fences, and they were supposed to do that. And occasionally, if you swing for the fences, you strike out. That's an American baseball expression, but I imagine most people can figure out what I mean there.
Yep.
And it's the risk management failures that I see are ones where after the thing collapses, there's nothing but finger pointing. The 2008 financial crisis, perfect example. Nobody could agree on who was to blame. Everybody was sure they'd been cheated by some massive global conspiracy, but it was pretty hard to figure out who the conspirators were because everybody lost money. The banks that were selling those mortgages that bankrupted their investors were buying those same mortgages. The only people who really made money in that were people who were complete mavericks, outside the system doing different things from everybody else. So that to me is a complete failure because nobody knew what the risks were. Nobody was tracking them. Nobody was saying, I'm willing to accept the risk of national housing prices declining because I can make so much money if they don't. They just weren't even factoring that kind of stuff in. People dramatically underestimated the risk of leverage, just the pure risk of leverage. And, leverage increases the volatility of your returns, but that's only one and frankly, one of the smaller reasons it increases your risk. So that's the kind of thing I point to. You get disasters in the United States in the 1980s. We had a savings and loan disaster. So a lot of these banks were giving out long-term fixed-rate mortgages, and when interest rates went up, those were lost a lot of money. But everybody knew what happened, right? They made a bet basically that interest rates would stay low. Interest rates went up, and they went broke. And I think they kind of knew that. Banks knew they were in the business of lending long and borrowing short. And everybody knew when interest rates go up, that hits a lot of banks. So to me, that's not a risk management failure. It's a bad design. You wouldn't want to design things that way. But it wasn't because people didn't understand the risks.
Yeah, and I guess if you look around today, we've got a lot of uncertainty in the markets. We've got volatility is rising, and I guess there are a number of external factors that could be contributing to this, like possibilities of trade wars and countries threatening each other and all that kind of thing. There's a lot going on that people could classify as risk. So how would a trader go about identifying the risks that could either impact them or are important for them to consider so that they can actually come up with some kind of plan?
Well, let me tell you a story about that might seem removed from current things, but it's Russia invades Ukraine back in whatever it was, 2010, something like that. And suddenly everybody's concerned about Russian securities, investments in Russia. And I get a call from a federal regulator who I will not name. And he says to me, what are you doing? What are you doing to protect yourself from all these risks of Russia? And I said, maybe you don't understand who you called, but we're a hedge fund. We're looking to make money. We're seeing this as an opportunity. There's a lot of risk. That's what we love. That's what we go and do. And we're making some long bets, some short bets, but we don't regard this as a problem we have to run from. And that turned out to be very politically unwise because at the time, the U.S. government seemed to be taking the position that any attempt to profit from the situation was treason. And we had to kind of backpedal and change things.
Yeah.
But so when you talk about risks in the market today, I say, great, that's what you want as a trader. These are things you got to understand. I think the trade war fears to me seem wildly overblown, given that the U.S. has been doing exactly this kind of thing for really 30 years now. The rhetoric has changed. You got a president who's proud of boasting about all his tough trade actions. But you look back and you say, President Obama, who was the opposite, very statesmanlike, very diplomatic, very soft-spoken, did exactly the same kind of stuff. And China reacted in exactly the same kinds of ways. So I don't really see any there. But that means there's a lot of opportunity for people to profit from other people overreacting to it. I could be wrong. We could be in for a significant change in global trade. I also don't think global trade, in the sense people keep records of it, is that relevant anymore. More and more, we see that the kind of things you can measure in trade deficits, which basically are physical goods moving from one country to another, are much less important than intellectual property, than services, than things that move around online. And so I think, a lot of people are looking at some economic indicators that just don't mean very much anymore. So that would be my personal take on that. In terms of the overall market, low volatility is usually more worrisome to a risk manager than high volatility, because it's low volatility when people lever everything up on the expectation that we're going to have, 10% stock market vol or 8% stock market vol. And when it comes in at 20 or 25, they blow up. When people are expecting 15 or 20% or whatever they're expecting, there's a lot less opportunity to be surprised on the downside. Plus, if somebody's expecting 20, they're mentally prepared for 40 or 60. But the guy who's expecting 8 often isn't prepared even for 10 or 12. So I actually think the problem with this market, to me, is lack of profit opportunity, not too much risk. It just seems to me in asset class after asset class and a lot of the quantitative trades people like, I just see really thin margins. Now, of course, sometimes that causes people to take too much risk. But personally, I'm happier when volatility is a little higher. I think that shakes things out and makes things a little safer.
Yeah. A little bit further on that, you just mentioned something about measurement in there. I remember there was a quote in one of your books. I think it might have been the Financial Risk Management for Dummies. I don't have it here, but I'm going to kind of paraphrase it. Apologies if I butcher it, but it was something about not confusing risk measurement with risk management. I think the idea was that if you can measure it, then you probably don't have to manage it. Firstly, did I get that correct? Because I'm not 100%.
I've actually said that a lot of times, and I probably was in that book as well, although I don't recall exactly where I had it in. Okay. Yeah, I used that tagline for years, especially because if you go to a big bank, the risk management department, you got maybe 2,000 people in risk, of whom 1,900 are compiling reports and back office stuff and monitoring things against limits. All of these measurable things that aggregate up to a nice total and basically reflect none of the actual risk of the bank. You got the other 100 who might be thinking about plausible extreme scenarios or, what traders are actually doing, the kinds of things you can't measure.
So what about those risks then that can't be measured? I mean, there's some that are easily or more easily quantified than others, hidden risks perhaps. So how do you go about trying to identify the hidden ones and, the stuff that kind of is a little bit left field that no one really thought about? How do you go about trying to think about those and identify those so that you can plan ahead?
Well, the big one is liquidity, at least for most financial shops, that you can measure volatility. You can estimate what it's going to be going forward. You can, measure interest rate risk. You can do things like that. You're not always exactly right, but you got a lot of history, a lot of data, a lot of theory behind it. But liquidity is kind of a slippery concept. It means different things to different people at different times. And I would say more financial plans get wrecked because you can't do the trades you had expected to be able to do, or you can't do them at appropriate spreads, or you can't do them in the quantity you want or the speed you want, rather than just getting the direction wrong. If you buy stock, it might go down, and you prepare for that, and maybe sometimes you don't prepare enough. But if you got a strategy that's, requires dynamic hedging and requires a lot of rebalancing and so on, you don't always think hard enough about what happens if, I can't trade. So that's really a big one. And an awful lot of the true risks in finance, when you really come down to them, are more about liquidity and trading conditions than they are about just gross movement of major market indices. There are some other things that are hard to measure, morale, which can go from, you got the right shop with the right morale, the right people in there, and they can surmount most problems. You got bad morale. You got people fighting each other, people worried about politics. You got rogue traders. It's really hard to measure that, but it's a huge difference.
Yeah. So how do you plan for those kind of things then that can't be measured?
Well, one thing you do is you do scenario analysis. So you just make up some scenarios. They're not actually going to happen. But, one thing you say is, okay, value at risk, for example. Value at risk says, okay, how much could we lose tomorrow if we couldn't trade? Now you might say, well, gee, that's a ridiculous thing to ask because, of course, we trade, and then we'd execute our stop losses and we do all this stuff and we hedge it and we get out of these positions and they got too volatile. But, I still like saying, fine, but let's talk about if you can't. And then let's think about that. And if that's a big number, a lot bigger than the amounts we're planning to lose, that tells you you're making some pretty, rigorous liquidity assumptions. You also get more extreme. You say, okay, what if the markets are closed for 10 days? I think it was 11 days after the 9/11 attack in the U.S. Or what's actually much worse for a lot of places is what if some markets are closed and some are open? We had a huge problem in the United States after Superstorm Sandy a few years back, where the New York Stock Exchange was closed just because it was flooded. It was underwater, so they kind of had to close. And the the banks were open. And that was a problem because you'd have margin calls. And if the Fedwire was open, though, you had to meet your margin calls. But if the New York Stock Exchange was closed, your money market fund wouldn't give you any money. So it turned out not to hurt anybody because there weren't any big price moves on that day, but it could have. And it actually lasted for about 3 days before things got really settled down. So in some ways, kind of the smaller disasters that close some things but not others are worse. Or things. So thinking about things like that are very important. Thinking about people in the company being out of touch. What happens if the top 3 decision makers are all out at the same time? Are people going to hide under their desks and not make any decisions, or are people really prepared to run the firm in a proactive, aggressive way without the sign-off of the top people?
Yeah. I just want to change the subject a little bit to drawdown now, because a common approach, I think, to managing drawdown for traders like retail traders, etc., is to determine at what level of drawdown they really start to feel uncomfortable and base their plan on that. However, I think I read in one of your books that risk should really be based on objective external circumstances rather than a personal preference. Can you expand on that a little bit more? Like, how should traders actually approach drawdown management?
Sure. I like my traders to be uncomfortable. I work if they're comfortable. So if they get out of every trade when they're uncomfortable, then I'm not. I don't see what I'm paying them for. The drawdown control is very important, and it's easy to do wrong. And it's easy to do wrong in a way that kind of guarantees you lose money. The sort of simple system, and I understand that this is not. It's not easy to apply to actual trading. You have to do a lot of things, but you basically say, okay, I got a thesis. If the price moves against me a certain amount, then either my thesis was wrong or some other event kind of intervened. So my thesis might still be right, but this other event came and caused a price movement. And what I say to a trader at that point is I say, okay, I'm not saying you have to get out of the position. You have to, get out of your thesis. If you want to, if you now no longer believe your thesis, great, get out, there's no problem. But if you still believe your thesis, get out now, wait until whatever's going on now, finishes, and then get back in. You might get back in at a lower price. You might get back in at a higher price. That's just a coin flip, because you don't understand what's going on. That was not part of your trade. And, but you can get back in with your thesis. And that doesn't cost any money. You haven't, on average, you don't lose any money, but you do prevent this unnecessary, uncompensated risk you've got in your portfolio that was not based on a thesis or a judgment, but based on an unexpected event for you. Once you know what that level is, sort of the level at which you didn't understand the trade completely, you were wrong, or something happened you didn't anticipate, then you can figure out how much you want to lose when that happens. And then you can size your trade. And then you can start thinking about, when you would get out, or profits you would take, or if things don't move for a certain amount of time. And you structure the whole trade that way. The risk manager's job in this, for a novice trader or a not very disciplined trader, the risk manager's job is to kind of do it for them or to force them to do it. But the real job, even for a very experienced trader, is for the risk manager to say, okay, Now, what if we do this all the time? Not just, this one trade. What if this is our philosophy of trading? And what you want to watch out for is what I would call, constructing a synthetic put option. If you, let's say you say, I'm going to get out. If my fund is down 10%, I'm going to get out of my positions, and I won't get back in until I've made it back up. Well, you'll never make it back up because you don't have any positions on anymore. You say, okay, well, I'll get back in if things are up 10% from the bottom. If I kept my positions on, it would be up 10%. Well, you start looking at rules like that, and you see some of them guarantee losing money. A synthetic put option, you actually lose money. It's just built into it. It is true that you limit your total loss, but, to me, that's saying, okay, you're not putting all your capital at risk, so why, just run with less capital? You got to run with some possibility of losing all your capital. It just happens, but you don't want it to happen, for without getting the compensation you need. You don't want you want to make sure that you're really getting paid enough to put your capital at risk. So the precise details of a drawdown control policy are very, very important, and you just got to say, okay. The simplest way is simulate. Say, okay, let's say I ran this for 1,000 years. How often would it make money? How often would it lose money? And it should be pretty close to costless. So if you design it right, you shouldn't have net losses. If you're building in expected losses, that's what I call buying the synthetic put, which is just protecting some of your capital and keeping it so it isn't there. If you know you're going to get back into the markets, you want to have a drawdown control policy with roll-off, where you say, okay, maybe 10%. If I have a 10% loss of capital, I'm going to start cutting positions, but I'm not going to wait until I make that 10% back. If say I measure my loss from the peak of the last 3 months. Once that peak rolls off, once you've done a month forward or something, that's no longer the peak. Maybe you're no longer 10% down, and you can put the risk back on. If you don't have roll off, you can really mess yourself up with a drawdown control policy.
Mm-hmm. Yeah. So at the start there, you were talking about changing your trades based on perhaps something indicating that your thesis or judgment was incorrect. What about, though, if you're running quant-based strategies or algorithmic strategies that they have the stops or the trade management built into the systems? Does that kind of change the way you approach drawdown management if it's more algo-based rather than discretionary?
Well, it makes it a little easier in the sense that it's pretty easy to simulate the strategy. So somebody's built the strategy. They've already sized the trades. They have all that algorithm. And you say, okay, let's run it for 1,000 years. Let's first run it under the assumptions the strategy was built for, where the strategy supposedly optimizes risk return. But let's say that's wrong, right? Let's run it on just a straight random walk. Let's run it as if the strategy has no predictive value. And let's run it under some other assumptions as well. And you look at those results, and usually you can find some sort of sweet spot, some drawdown control policies that protect you against the most likely. And when I say errors, you may not have made an error. You might have done perfectly good analysis, but the world just, you just got a funny draw from the world. You might say, well, gee, there's only a 1% chance of such and such happening, but it happens. That you have lost the appropriate amount of money in those cases. That you might say, well, gee, if the stock market falls 40%, I think the strategy should lose 10%, and I'm comfortable with that. Or if there's very high volatility and we get whipsawed a lot, I could see losing some amount of money. And you look through these scenarios and discuss them, and it usually comes out to there's a pretty good agreement on where the drawdown should be. And again, this goes back to what I said before. As a risk manager, you don't have some magic thing that tells you here's exactly the optimal drawdown policy. But what happens is if you do have a drawdown, it's a situation you've discussed and people agreed this is what they wanted to do, and nobody can say, gee, we should have cut things earlier or whatever. In the absence of a good quantitative drawdown control policy, what people do is they wait too long to make cuts in their positions. When they make the cuts, they make them too big. They don't do, gradual 5% cuts. They do a 50% cut, or they get all out even. But the biggest problem they have, the biggest human weakness, is they wait way too long to put positions back on. Because the world never feels safe, right? I'm thinking, let's say 2008. Okay, so your drawdown probably kicked in early 2008. You were probably running maybe at 75% risk in September. You kind of immediately went down to whatever your minimum risk level is. I think 50% is often a good number. You should, if you don't believe in your strategies at 50% of their normal size, then maybe you don't believe in them at all. But by December, all the indicators are pointing up. You should be getting back up to 100%. And virtually nobody who was making qualitative decisions did that. People were still afraid of another Great Depression. They had lost way more than they ever thought they were going to lose. They weren't paying attention, or they weren't able to really focus on the fact that, the volatility has gone down, the markets are going back up, the strategies that, completely failed in the last 3 months are now working again, and working better than they're making up the ground. And if we don't get back in now, we're going to miss the upswing, and we'll never make that money back. So that's why I'm a firm believer in a good quantitative drawdown control strategy that you've simulated. You've seen how it runs, and you're happy with the results. One difficulty is, by the way, if you take any drawdown control policy and you run it through 2008, it's going to work fantastic. You're going to think it's the greatest drawdown control policy ever. It doubles your profits and get rid of your risk. You got to look at it also in the situations like from 2002 to 2007, or from 2009 to 2013, where you're not getting any big drawdowns and it's costing you some money. A big problem people get, and this is for all kinds of risk management, not just drawdown control. After a big disaster, they get serious about it. They put in really rigorous, expensive programs. And then the years go by and, profits are coming in and the risk management is costing a lot of money, and they've kind of forgotten about how bad it feels to lose a lot of money, and they think it'll never happen again. So after having paid, you might think, the insurance costs for 4 or 5 years, they start cutting back, cutting it down. And then when the next crisis hits, they don't have any of that in place. You gotta pick something and stick to it if you're going to have any success at risk management.
Yeah, I think one of the tricks there is trying to find a balance between risk and opportunity cost. And, is there any tricks to finding the sweet spot there, or is it really all about just testing all the simulations and see what comes out?
There probably are some tricks to the sweet spot, but it is so much more important to pick something and stick to it than to pick exactly the right thing, that I kind of discourage people from thinking too hard about it. The guy who's, set his risk limits 50% too big, or his drawdown kicks in too soon, whatever, that guy's going to be okay as long as he's not got a completely perverse system and he sticks to it. The guy who spends a lot of time and effort and figures out it's exactly 17.3% is when we should start cutting risk, and we should cut by 8.11%, that's no better, no worse. Maybe it's a little better. Let's say he's actually doing some useful work and his slightly better thing. But if the minute things happen, he's going to, refigure it and change it, he's going to get killed.
Yeah. I guess if you're going to that kind of level, it almost sounds like you're curve fitting your risk management just the same as you can really overfit strategies. So I think there's probably a danger there in being too precise, perhaps, with your risk management. Is that fair to say? What do I want to say here? Yeah, I guess you could, but I don't think that's too big a practical problem. I think the problem is really just, risk management system you don't truly believe in. The best situation to be in is to be an experienced trader. You've been using the same thing for 20 years. You have confidence in it, and you can do it. But if you just put in a new system and, costs you a lot of money the first year, you don't really believe in it, it may not really help you very much because you don't have the faith in it. Remember, the purpose of this is not just to reduce or mitigate the worst losses. It's also to give you the confidence to hold big, risky positions when you can't afford it. And there are times when you've had some losses, but it's really time to get those positions big. So, half the point of risk management perhaps is to mitigate those huge drawdowns. But another half is to give you the confidence not to be cutting back at times. Yeah. Okay, I just want to move on now to portfolio construction, because one technique that traders will often use to reduce risk is to create a portfolio of diversified strategies or diversified investments. What are your thoughts on this? Is that actually an efficient way to reduce risk?
Oh, it absolutely is, but I don't call it risk management. And here's what I say. There's a very hard problem. The portfolio management problem is a very hard problem, portfolio construction, because you got thousands and thousands of possible positions. You can, hold them long or short, an infinite variety. You can trade, every microsecond or every millisecond anyway, or you can trade, once every 10 years. So you have this enormously complicated and difficult problem. From a mathematical standpoint, you don't have anywhere near the data you need to solve it, so you have to rely on theory or intuition or trading experience or something like that. And as a result, we know that even the best portfolio managers, the best traders, frequently lose money. For quants, it's maybe 51% of days you hope to make money. For qualitative traders, maybe they hope to make 60, 70, 80% of their trades work out, depending on how they structure and what kind of profit ratio they go for. But we know it's hard. And therefore, even if somebody's had a lot of losses, you don't say, well, they're doing it wrong. Risk management is relatively easy. Risk management isn't saying what is the best portfolio to hold at the time. Today, risk management is saying, okay, given that you want that portfolio, what's the best size to hold it in? And what are the risk parameters, the stop losses, the drawdown controls, the other risk parameters to put around it. And the reason I emphasize that it's an easy task, it's quantitatively much, much easier. It's much lower dimensional. You don't have thousands and thousands of variables. You got, 4 or 5 big variables, your stop loss point, how your drawdown works, whatever. You got a lot of history to build it on. And it doesn't matter if you're off a little bit. Portfolio construction, you get things a little wrong, you can turn a winner into a loser. Risk management, if you're a little wrong, you just, not quite as, perfect as you wanted. So, but the problem is, a lot of risk managers use the same kind of excuses portfolio managers do, right? They screw up and they think they could be right, 51% of the time or 60 or 70. Risk management, you really ought to be right 99% of the time. It's just, you got to remember this is something pretty easy to do, and you should do it right.
Yeah, also I think traders will often look at correlations between the strategies and markets to construct a portfolio. Now, there are obviously shifts in correlations over time. Do you think that's a good approach to use for portfolio construction, or are there some drawbacks to this particular technique?
Yeah, I don't believe in correlations. I think correlations are mythical. Here's the right way to really think about financial markets is that there are thousands and thousands of factors out there. Some are big ones we know about, like interest rates and what the central bank is doing, and what GDP growth is and things like that. But there's also little ones like whether the Swiss franc is pegged to the euro, whether Russia invades Ukraine or things like that, whether it's a cold winter in the Northeast United States. And most of these factors are kind of dormant. A few of the big ones are always there, always moving markets. But each factor has a different correlation structure with all financial assets. So when we get a big move in the market, it's usually not because interest rates suddenly became twice as volatile, GDP growth became twice as volatile. It's usually because some dormant factor that hadn't affected markets for 30 years suddenly rises up and has a lot of volatility and is moving everything. Maybe it's energy prices. Energy prices are kind of a medium. They're not always important, but sometimes they're very important. It might be trade negotiations. It might be the euro breakup. And whatever, and when this happens, you can't count on historical correlations because this new factor has a completely different set of correlations and everything else. So rather than count on correlations, unless they're very high and have a strong economic motivation, oil prices are going to be correlated with gasoline prices. That's a correlation you can put some faith in, although, sometimes it can fool you. But for other things, the correlations just are not very meaningful or useful for a risk manager. The correlations might help you predict your volatility a little better. They're not going to do any good for you in the tail events.
Yep. Okay, so what do you think are some of the challenges of measuring and understanding risks in a portfolio? I know that you said that it's quite complicated because there's lots of little bits and pieces, but what about from a higher kind of level? What are some of the challenges that traders can look out for when they're trading a portfolio?
Well, okay, I'd say the first thing you do, and these are things that the traders to do, you should have some idea of what your exposures are. And I call these the Greeks, from a derivatives trading standpoint. You say, okay, how can I model my portfolio on some major market factors for which I can get a lot of long-term data? And maybe you say, okay, I got a 0.3 correlation to, or beta to the stock market. I got 0.2 to long-term treasury bonds. I got a negative 0.2 to oil prices and so on. You got to figure those out, and from those you can kind of figure the volatility. And the next step is, what are the things that the most likely big things, the common things? I'm not talking about wild out of the blue things that nobody expected. What are kind of the expected risks that maybe the half dozen or so that you can mention about these positions? And this is what you use to size the positions. This is what you use to set them up and figure out your stop point and your take profit points and things like that. And that's, I don't want to say that's easy. Trading isn't all that easy, but it's pretty straightforward. You don't have to think about things that never happened before. Then the hard part is to come in and say, okay, how much are we relying on liquidity? How much are we relying on being able to get leverage? How much are we relying on things not just being correlated, but actually moving at the same time? There's a concept, I don't want to get too geeky here, called co-integration. Two things that are co-integrated do tend to move together at the long term. They kind of, have an economic relationship that kind of keeps them in a certain relationship to each other, but they don't move at the same time. And often traders take advantage of this in things like pairs trading. But it can often kill you, that you got two things that are correlated, but the thing that went down now, and the thing that's going to go up and make you your money back is not going to happen for a week. And in between, you get closed out of your positions and blown up. So these are the kinds of things, the market trading things, the unusual events. These are the kinds of things a risk manager thinks about. And one of the mottos I have or rules I have is that there's an infinite number of things that can happen, but there's actually a fairly small, finite number of ways they work out. So you don't try and guess every possible future scenario. You say, okay, what if we have a cash crunch? What if we got a margin call we're having trouble meeting, or what if our financing gets pulled? What if we can't trade things and we get frozen? If you're shorting stocks, what if the stock gets delisted and I'm paying some incredibly high cost to borrow and I can't get out of it? And, even if I'm right and the stock goes to zero, I'm still losing a lot of money. These are the kinds of things that you can think through. One hard part is just doing it, right? It's easy just to say, usually none of those things happen. Who cares? But the other hard thing is to stop doing it. Once you got like 5 or 6, you've really done your job. You've thought of the likely things that are going to come through. If you try going and do 20 or 50 or all of them, you never trade. You spend all your time thinking of weirder and weirder things that might happen.
Okay, thanks, Aaron. I want to kind of switch to the state of the markets today or now. Now, as you mentioned earlier, risk management isn't really about predicting risks, but more about considering potential scenarios and having a plan for if and when things do turn ugly. So what do you think about the risks in the market today or at the moment? What do you see are some things that traders really should be thinking about or considering when they're coming up with their own risk management plans?
Well, again, I think the low expected returns is the big one. So I don't see this as a particularly volatile or unpredictable time. I mean, listen, something totally unexpected could happen tomorrow, and set markets in all kinds of different directions. But it just doesn't seem likely, at least compared to most times. It seems like the basic scenarios are out there. The kind of basic sort of trading that usually works should continue to work. Momentum, value, quality, arbitrages, and so on. I don't think, it's a position where you're more likely to get blown up using traditional amounts of leverage. If you're doing 2 or 3 times leverage in strategies that, typically do that in normal times, I think you could even go higher. I would actually probably even use more leverage now than I would in average times. So I don't see like something coming straight out of the blue and blowing everybody up or some unusual amount of volatility. I think people are prepared for about the level of volatility that I expect to see, and I don't see anything on the horizon that could blow up the volatility. It can still happen from something I didn't see, but if you're not willing to, put up the leverage and trade pretty aggressively in a market like this, maybe you should think about other careers. But the problem is you can do that and not make very much money. And most of the traders I know aren't complaining that they have too much risk or they got, outcomes they really didn't expect or, bad luck. They're saying, yeah, I'm doing everything right, everything's working, but I'm only making a third as much money as I did doing these same things last year and the year before.
Mm. Yeah, I think I saw an article, I think it may have been on the CNBC website in the last week or so, someone comparing the 87 crash to today. Do you see any similarities between then and now?
I really don't, which isn't to say they aren't there. I didn't read the article. Maybe they came up with some, but I guess my guess is what the article was saying. You can tell me if I'm wrong here. Is that a lot of the market was on autopilot. And that is true. In 1987, before the crash, a lot of people had kind of pre-programmed what they were going to do, and those programs didn't mesh with each other. You can program what you're going to do, but if everybody says, okay, I'm going to sell, and there's nobody to buy, then your plan doesn't work. And I think there's an awful lot of that. Now, the pre-programming in the market today is far more sophisticated, and I don't think it's dangerous. I don't see that as a danger. I would have to say, yeah, the danger in the market today is not, to me, a crowded trade, everybody rushing, or quantitative algorithm blowing us up or something. It's just that the market's just not providing the kind of return that we need for social peace. Pension funds can't earn enough to pay their pensions. Governments can't earn enough to fulfill their promises. Individual investors saving for retirement can't make enough to retire, and that's going to that could cause some real problems.
I just want to ask you about one other market before we start wrapping up for today, and that is the cryptocurrencies or the Bitcoin markets. What are your thoughts on these?
Well, years ago, 2013, I decided to put 2% of my portfolio in crypto, and I haven't changed that since. I haven't, felt that there's any reason to modify that. So I consider that kind of a neutral position. I have little doubt. I'm pretty confident that over the next 10 years or so, trustless value exchange is going to be very, very important. The internet is 6% of the global economy. I think trustless value exchange and fat protocols and things like that are going to be about 2%. Obviously, who knows? It could be 0.2%, it could be 50%, it could be 0, who knows? But, 2% seems pretty reasonable to me. The real question I have for crypto is, will current investors in crypto capture that value? A lot of it may be captured by users. A lot of it may be captured by developers and founders. Some of it may be captured by other sorts of participants. So when you're investing in crypto, you really have to, you can't be sure. But I worry less that the crypto I own will, the idea won't work out. It'll be a technical failure, a market failure. I worry more that it'll be a success, but I won't get paid. Looks to me, kind of looking at the market, that most of the froth was in Bitcoin, Ethereum, the two big ones, plus some kind of really frothy, trendy ones. Where I see the solid quality these days is the second tier. If you look at each type of currency, each type of idea out there, and you look at, okay, what's the biggest, most successful crypto asset, token, coin, whatever of that type, those actually have held their value. And those seem to be even, relative values. I still believe in Bitcoin. I'm market weight Bitcoin. I still like Ethereum. I'm market weight Ethereum. But I've kind of pulled back from a lot of the more speculative and smaller, less successful ideas, and really looked for the solid contributors in each space. That's just a view today. I can change that view tomorrow and move around, but that seems to be where the value is at the moment. And every penny you put in any cryptocurrency, including Bitcoin, can go to zero, and it can go to zero tomorrow for no reason. It's not, everybody should understand that about everything you put into this. And 10 years from now, I'm pretty confident people will come back and say, hey, cryptocurrency is really great, but they may be entirely new cryptocurrencies that, none of the existing cryptocurrencies today might have any value, tomorrow, but certainly not in a year or 5 years.
All right, thanks, Aaron. Well, in our chat today, we've kind of, we've obviously focused on risk and risk management. I think we've only really just scratched the surface, and there's a whole lot more to it than, what we can cover in 45 minutes. So how can traders learn more about risk and risk management?
Well, the easiest way is to get in the markets and lose a lot of money. There are cheaper ways. I think talking to other traders, and really getting if you're an individual trader working for yourself, it's very important to be in a network.
Yeah. Okay, excellent. Well, I just want to start wrapping up now with some quick closing questions. The first one, what's the biggest lesson you've learned through trading?
I wouldn't call it a lesson. It's a feeling. There's a feeling I get from trading that I don't get from anything else, a connection to another reality, a kind of both euphoria and kind of a little scary, dangerous sometimes too. But it's a big part of my brain, my personality, and I wouldn't give it up.
Yeah, okay, awesome. What's the best trading advice you've ever received?
It's only money.
That's a good one. It really definitely puts it into perspective, right?
Well, the thing I like about finance is, nobody dies. And even more important, I guess, whatever mistakes you make today, you can, make it up tomorrow by making twice as much as you lost. I would hate to be in a position, an airplane pilot, a surgeon, an infantry commander, where you get people killed and there's nothing you can do to get them back.
Yeah. Now, you've published a number of books, and you've also got a website. Can you share what's the best way for listeners to either get in touch with you or to learn more from you?
Well, they can come to my website, which is eraider.com. Yeah. And they can contact me through email, I guess, rather than giving the address here. If they search for me on Bloomberg, Aaron Brown on Bloomberg Profits. Bloomberg Profit. I didn't ask for the title, but they put it on me. And there are lots of us, and most of us aren't real prophets, I have to tell you. And that has an email address for me there.
Okay, awesome. All right, well, thanks a lot for your time today, Aaron. It's really great chatting to you. Is there anything else that you'd like to mention before we finish up?
No, good luck to you and all of your listeners. And for those in Australia, I don't know if that's the majority or something. You have a great time zone advantage. If I were going to go back and do a lot of serious trading today, I would consider trading in that time zone.
Yeah. Also, well, thanks a lot, Aaron. It's really great chatting to you today. I'm sure a lot of people are going to find a lot of value in what you've shared with us. So thanks again, and I wish you all the best.
Thank you, Andrew.
Cheers, mate. Bye. Okay, well, that's it for this episode. Thanks for listening. I hope you enjoyed the show. Come on over to bettersystemtrader.com. That's where you'll find all the previous episodes, all the transcribes, all the show notes, and all the free weekly trading tips. bettersystemtrader.com.